Google is down over 7% today after the company reported its earnings. Microsoft is also down roughly 3%, and AMD is down 2.5%. These stocks all saw weakness after their earnings came out. I went through all three earnings reports to see what was going on, and in this video, I'm going to share everything that I found. Additionally, my book, The Fundamentals of Investing, has been approved for release on February 5th on Amazon. So if you're interested in getting a copy of my new book, then you will be able to purchase it from Amazon next Monday. I'll also be making a video here on the channel going through the book's content so you can see if it is right for you. But with that being said, let's now dive right into the video. Alright, so as I said, Google is down a whopping 7.3% today after the company reported earnings. So the market clearly was not very happy with what Google reported. So I went through Google's entire Q4 2023 report and I found all of the good and bad that investors need to be aware of. So let's go through everything. And let's start from the top right here where we can see that Google's revenue did grow by 13% year over year for the fourth quarter, which actually was above my own expectations. I was expecting around 10 to 11%, so seeing 13% year-over-year revenue growth is actually a great thing to see personally. We can also see that operating income came in at $23.7 billion, which is also above my own expectations, and the operating margin increased by 3% to a net of 27%. So Google's operations are actually becoming more profitable as the revenue grows as well, which is great to see as a shareholder. Net income was also $20.7 billion, which is up significantly year over year, and diluted earnings per share was $1.64 on the quarter and is now $5.80 in the trailing 12 months, which is up over 20% year over year. So overall, Google's revenue, operating income, and net income are all growing by double-digit growth rates, and I think that this is a great thing to see. So far, there's actually not any red flags for me. Now here we have the different revenue segments of Google's business and the different growth rates to their segments of the business. So here we can see that Google search grew by 12.7% year over year. YouTube ads grew by 15.6%, which is great to see. However, the Google network saw a decline of 2.1% year over year. I think that this may be one of the sticking points in the entire earnings release that investors were not really happy about, because the Google network is seeing lower advertising revenue year over year. However, as we can clearly see, the other segments of the business are all growing at double-digit growth rates and very healthy double-digit growth rates at that. So moving on, we can see that Google subscriptions revenue is up 22.7% year over year, and Google Cloud is up 25.6% year over year, and this is actually an acceleration in revenue versus last quarter. So Google Cloud's revenue is starting to grow at a faster rate once again, which I do think is a great thing to see. Then we can see that the total revenues for the business was up 13.5%. So overall, the business is growing its revenues quite well. Now, another very positive thing is Google Cloud is now adding to Google's operating income. And Google Cloud produced $864 million of operating income in the fourth quarter, and its operating margins are continuing to improve. So as Google Cloud continues growing now, it should be adding to Google's bottom line and increasing its overall profitability and operating income. This is a great thing to see, especially because Amazon and Microsoft's clouds are incredibly high margin businesses. So Google Cloud should be the same theoretically, and as this business continues scaling and growing, overall Google's profit should continue scaling and growing as well. Now, here is the income statement for Google, and the main thing that I want to point out here is that Google's share count did decline by 2.7% year over year, which means that the business is buying back shares, and in general, they did buy back 2.7% of their shares, or a net of about 345 million shares were removed from the market. Now, keep this number in mind. 345 million shares were reduced by buybacks in the year of 2023. Now, moving on to my personal favorite financial statement, this is the cash flow statement right here. And there's some interesting things that I think we need to add some color to. So right away, starting from the top, we can see that stock-based compensation over at Google is still growing. This is a sticking point on the release as well. You guys know me, I do not love a lot of stock-based compensation, and unfortunately, Google does a lot of stock-based compensation. And we're going to see why this kind of lowers shareholder value over the long term. Now, the next major sticking point here is the income tax expense that I discussed in my last video before Google announced their earnings. This is why the operating cash flow declined year over year for the fourth quarter from 23.6 billion to 18.9 billion. So I think that people may have looked at this right here, the net cash provided by operating activities declining year over year, and saw that as a negative thing. However, Google was making it clear to investors, well, actually, you had to look deep in their financial statements, but their operating cash flows were being boosted throughout the year of 2023 because they were deferring an income tax expense to the fourth quarter, which they ended up paying on October 16th, which was in the fourth quarter. This was a $10 billion income tax expense, which you can see right here, which directly hurt Google's operating cash flow for the fourth quarter. So that is why it is down year over year so dramatically in the fourth quarter. We can actually see that last year in the fourth quarter of 2022, Google had an income tax gain of $1.4 billion. So there was a net difference of about, what is that, $11.2 billion year over year just from income taxes. So that's why this quarter was so weak. Now, if we take a look at the trailing 12 months or the year ended 2023, we can see that Google's operating cash flow was $101.7 billion, which did increase by about 12% year over year. So on a full year basis, Google's operating cash flow did actually grow, and this is the normalized operating cash flow. So this is the comparison right here that I personally am going to be focusing on because it neutralizes the income tax expense. And then you can see that Google's operating cash flow is in fact growing. Now, another thing that I did not love to see is Google's CapEx right here is now $11 billion. And last year it was about $7.6 billion. So the CapEx did grow quite significantly year over year. This is also at the same time as operating cash flow was down. So Google only produced about $7.9 billion in free cash flow for the fourth quarter, which is actually a pretty dang weak quarter for free cash flow. It's lowering the company's trailing 12 months free cash flow now because the CapEx is growing quite substantially. For the full year of 2023, Google had $32 billion of capital expenditures, which means that they did produce $69 billion in free cash flow for the year. Now, we can see down at the bottom here that the company repurchased $61.5 billion worth of stock, which means that almost all of their free cash flow is going to share buybacks at the moment. Now, this next screenshot discusses the share repurchasing that Google did over the year. So here we can see that Google actually repurchased a total of 528 million shares. However, remember earlier, the company's total share count only declined by about 350 million shares. Why this happened is because Google does so much stock-based compensation. This basically means that Google issued around 230-ish million shares just in stock-based compensation, which dilutes shareholders. So the 528 million shares that Google repurchased was not totally accretive to creating shareholder value because a large portion of that was offset by stock-based compensation. This is why stock-based compensation offsets share buybacks and why I think that a lot of stock-based compensation can be a red flag when I am analyzing a business, because it is a real dilution to you as a shareholder. And it basically means that Google's $61 billion in buybacks was not as effective as they seem. Basically, $20 billion of those buybacks went to just offsetting the stock-based compensation and dilution that is coming from issuing shares for employees. So the actual return to shareholders, the actual value created for shareholders was only about 2.7%. Now, the reason this also kind of sucks is because, as we saw, Google is putting almost 100% of its free cash flow to buying back shares right now. So they're taking all of the company's cash flow generation, buying back shares, and the net return to shareholders on that is only about 2.7% after the dilution from stock-based compensation. That is not a high amount of value created for shareholders. And it's honestly not that great to see. That is basically what the company can return to us using all of its cash flow right now, is around 2.7%. Not a very high return. So that's the way that I kind of think about stock-based compensation. It dampens and lowers your returns and your value created as a shareholder for sure. Now, on the conference call, an analyst, Justin Post, asked about the high capex of $11 billion on the quarter. And the CFO basically came in and said, yeah, this is normal. We were saying that this was going to happen. And for the next year in 2024, Google is expecting this level of capex for the full year. So Google's capex is increasing significantly over the next year, and this is going to lower free cash flow. So I do not think that investors were very happy about this either. So there was some great things in this report. The revenues, operating income, net income, and operating cash flow all increased by over 10%, which was a good thing to see. There's also Google Cloud reaccelerating. YouTube is growing well. Google subscriptions is going well. And overall, the business is growing very well. However, there was some negatives in this report as well, like the Google ad network declining, a lot of stock-based compensation going on, and the higher capex expected for 2024, which is actually going to probably harm free cash flows quite a bit. Now, in addition to that, as I said in my video yesterday, Google's price to operating cash flow was right near the high end of its historical ranges, which means that the business was actually on the more expensive end relative to how it was trading historically. So even though Google, in my opinion, had a pretty dang good report, it is still down 7% on the day because the stock was trading right near its all-time highs in terms of its price to operating cash flow ratio, which means that the stock was actually quite expensive in pricing in a nearly perfect report. So if anything other than perfection happened, then Google would see its stock price decline, which is exactly what we're seeing today. If the stock was not trading for such a high price ratio, then this obviously would have been a much different outcome because again, this was a pretty good report. Like as a shareholder, I'm pretty okay with this report. I'm actually quite happy and they did beat my own expectations, but the market was just pricing in perfection, I guess. Now let's take a quick look at my discounted cash flow calculation for Google to see if it is trading for fair value today. So I use the operating cash flow metric for this business because they're going through a high capex cycle right now. And I am saying that Google is going to grow its operating cash flow by 10% per year, buy back about 2% of its shares annually, and trade for a price to operating cash flow of 17, which is around the company's historical average. If the company can achieve this, then its fair value is $151, and it should grow by about 11% in the future. Again, that is roughly 10% growth, 2% buybacks annually, and a 17 price to operating cash flow in the future. And if we lower this growth rate down to 8.8%, then we can see that this is what the market is currently pricing in for Google stock. So basically, for Google to be considered fair value today, it has to be able to grow its profits by 10% annually over the next 5 years. Now, personally, I would want a little bit more of a margin of safety before I add to my Google position. So I am not going to be a buyer of this stock quite yet. I would like to see it fall some more. And that is just kind of my own opinion on the stock and kind of my opinion on its earnings that came out yesterday. So now let's move on to Microsoft really quickly. As we said, the stock is down 2.7% on the day. It's back below $400. And honestly, Microsoft had a fantastic report. They freaking killed it. But the stock is still down today. And I think that just shows us how priced for perfection these stocks are today. So I have some screenshots that we can go through with Microsoft as well. Here we can see that Microsoft's revenue was $62 billion, up 18% year over year. Operating income was up 33% and net income was up 33% as well. Microsoft is growing incredibly well, way faster than Google. They also say strong execution by our sales teams and partners drove Microsoft Cloud revenue to $33.7 billion, up 24% year over year. So Microsoft Cloud is a $33 billion business growing at 24% a year. That is crazy. If we also take a look at Microsoft's different segments of the business, we can see that all of them are growing pretty much and by quite strong growth rates as well. The only place that is not growing is the devices, which dropped by 10% year over year. But overall, you can see the growth rates right there for yourself. Microsoft's businesses, all of their different businesses are growing and quite freaking well. Now, if we move on to Microsoft's cash flow statement, we can see that its stock-based compensation for the 3 months ended December 31st was only $2.8 billion, which is actually roughly half of what Google pays its employees. Now, what's also interesting is Microsoft produced more operating cash flow. So their operating cash flow was higher, and they're paying their employees much less stock-based compensation, which is diluting shareholders much less. This is a great thing to see. I'm not a shareholder of Microsoft. The stock is way too expensive for me, but you guys know that I do not like high stock-based compensation, and Microsoft's stock-based compensation is much more reasonable than Google's. Also, Microsoft's operating cash flow increased by something like 40% year over year, so that is growing very well. However, their capital expenditures did grow to about $9.7 billion, so the company produced about $9.1 billion in free cash flow for the quarter. Now here we can see that they bought back $4 billion worth of stock and paid out $5.5 billion in dividends. So all of their free cash flow is basically going to buying back stock and paying dividends now. And that is where the company's profits are going, is returning it to shareholders. So overall, Microsoft's report was honestly very good. It is actually surprising me how quickly this company is still able to grow at its massive scale. It's a $3 trillion business that is growing its revenues by nearly 20% and its profits by anywhere from 30 to 40%. That is really, really freaking good, okay? The one thing that I just cannot get over with Microsoft, as I explained very well in my video yesterday, is its price. It is still trading for a price to free cash flow of 45, which is a free cash flow yield of only about 2.2%. That's way too low for me to be interested in the stock. And it tells me that the stock is actually, in my opinion, quite overvalued and expensive today. If we actually go to Stock Unlock's discounted cash flow calculator again, we can see what the market is currently pricing in to Microsoft's stock. So here we're projecting out the free cash flow over the next 5 years. And for Microsoft to be considered fair value today, it has to grow its free cash flow by 18% annually, buy back about 1% of its shares annually, and trade for a 30 price to free cash flow, which I do think is much more sane for this business than a 45 price to free cash flow. So basically, the market is already pricing in an 18% annual growth rate to Microsoft's free cash flow over the next 5 years. This is what Microsoft needs to do just to justify the stock price today. Now, if we scroll down, we can see that this means Microsoft needs to produce about $153 billion in free cash flow by the year of 2028, which is a total growth of about 150% to the company's cash flows today. That's a lot of growth to the company's cash flows annually over the next 5 years. And again, this is what the stock is just pricing in to its valuation today just to be considered fair value. For example, if Microsoft only grows its free cash flow by 12% annually over the next 5 years, which is still a good growth rate, then the fair value is $307, which is about 23% below where the stock is currently trading, and the stock will only deliver a compounded annual growth rate of about 4.5% over the next 5 years. And this is why I say that there is risk in buying stocks at very high price ratios, because even if the business grows and it grows quite well over the next 5 years, investors can still end up losing money or not really making significant returns. It all depends on how much future growth you're already paying for today. And in my opinion, Microsoft is pricing in a lot of future growth today. So when you buy the stock today, you're actually already buying like the next 5 years of growth, at least in my opinion. This is also why I speculate that Microsoft's stock is not going to produce high returns over the next 5 years. But that's just my speculation, and that's why I personally do not own the stock. But in terms of Microsoft's earnings report, it was incredible. The company's doing well, and they knocked it out of the park. Now we're going to move on to AMD. This stock is only down 2.5% on the day, which I think is it's not enough. I went through this company's earnings report, and I cannot for the life of me understand why this business is so expensive today, and why the stock is still near all-time highs. So I have a few screenshots that I took from AMD as well. Here we can see that for the full year of 2023, the company's revenue actually declined by 4%. That is interesting. For the fourth quarter, year over year, the revenue did grow by 10%, but for the full year, again, revenue was not really growing. Now, if we take a look at the next slide, revenue was up 10%, gross profits are up 10%, and net income was also up 12%. So year over year, the business is growing by about 10 to 12% for the fourth quarter. That is good to see, but it is not incredible, okay? It's really not incredible. Now, what they also projected for their outlook was the first quarter of 2024, they're going to do about $5.4 billion in revenue. This is growth to the revenue year over year for Q1 of only 1.8%. So they're basically not projecting to grow the revenue at all in the first quarter of 2024. Now, additionally, in the fourth quarter in their recent earnings report, they reported that their operating cash flows are declining, and they declined by about 40% year over year. So this is a business where the revenue is not really growing, and its cash flows and its profits are actually going down. Now, despite this, the stock is still selling for all-time highs today. It's trading for a price to free cash flow of 200 and a price to sales of 12.57. A price to sales of over 10 for a business where the revenue is not really growing and profits are declining. That to me is absolutely wild. I do not understand why AMD is up so much. And maybe it's because they're exposed to this whole AI wave and this AI hype in the market right now. But in my opinion, the fundamentals of AMD and its stock price have totally disconnected. I don't understand why this stock is still up. Like, in my opinion, if I read that earnings report, I would think that the stock should be down 30% today. Like, no joke. I think that AMD is incredibly overvalued right now. Again, I think the fundamentals and the price of the business are totally disconnected, which means that there's a lot of risk in the stock, in my opinion, because over the long term, stock prices will reflect the fundamentals of the business. So if the stock price is really high, but the fundamentals are not really following the stock price up, then eventually, if the fundamentals don't grow exponentially, then that stock price is going to come down to meet the fundamentals. So that's why I think AMD is quite risky. And just looking at the fundamentals, like, it's really, I don't really see that much to be attracted to right now. Like, let me know what you guys think in the comment section below about AMD, but Yeah, I'm not touching this one at all. I'm not even interested in it. So that is my opinion on Google, Microsoft, and AMD's earnings that they reported yesterday. And if you enjoyed this video or you found it helpful in some way, then please remember to leave a like on it. It really helps out the channel and I really appreciate it. And again, my book, The Fundamentals of Investing, which you might be able to see in the background right now, is going to be released on Monday next week. And as I said earlier, I will be doing a video here on my channel discussing some of the content within the book so that you can know if it is right for you as an investor. I am so thrilled that the book is done though, and I cannot wait to get it in your guys' hands and see your feedback on it. I put my freaking heart and soul into this book. I've been writing it for about 3 years now, just plugging away at it consistently, and it's finally done. It's honestly the best work I have ever done, and I just think that it is a great book. I think it's got a lot of value in it. So next Monday, mark your calendars. It will be available on Amazon, and I will do a video and give you guys the link to go and get it if you're interested. But with all that being said, thank you all so much for watching. I truly do appreciate it, and I really hope to see you all again in my next video.